Welcome to Finance in Excel video number 67. Hey, if you want to download this workbook for Chapter 7 or the PDFs for Chapter 7, click on the link directly below the video and scroll way down to the Excel Finance class section. Hey, in this video, we're going to use a look at a non-constant growth problem. And we're going to combine the model we've been using, the constant dividend growth model, and some discounting future cash flow techniques into one, because ultimately, if you can figure out the future cash flows, right, you can discount them back given some assumed discount rate. So here's our example. Suppose a firm is expected to increase dividends at 20% in 1 year, 15% in 2 years. After that, dividends will increase at a rate of 5% per year indefinitely. If the last dividend was $1, which means dividend at time 0 and the required return is 20%, what is the price of the stock? Remember, as with any asset, if you can figure out the future cash flows, you can discount them back and value the asset. All right, let's look at some calculations and then a picture, and then we'll go over to Excel and see if we can calculate this. Well, first off, we can calculate the dividends, right? We know the dividend at time 0. So we can just multiply that by a principal plus the interest. We got 120. So at time 1 year out, we have that cash flow. Year 2, we multiply this one times the 15% increase. Then we take this one, and finally we get dividend at time 3 at the 5% growth, which is assumed to continue into the future. Now, guess what? With this dividend here, this is at D3, time 3, we can figure out the price at time 2. So price at time 2 is dividend 3. So we simply plug that in, subtract this, and get that. Now we have all of our cash flows. We have cash flows here, and at time 2, we have a dividend, and we have a price. So now we discount these back. Here's the picture. Okay, we have this one, so we're going to have to discount it back using our normal techniques. This one. And the only trick was you had to figure out, once you have a dividend here, you need to, at the constant rate, go forward one ahead, calculate the price at time 2, right? So we have this cash flow and this cash flow, and we discount them back, add them all up, and that should be our price. All right, let's go over to Excel. So dividend at time 1, our first rate, second rate, third rate, and our discount rate. So dividend at time 2. I'm going to say $1 times, open parentheses, 1 plus our 20%. Now, I'm going to notice something. I have a 15 right there. That green box should move down, but I want that one locked, so I'm going to hit F4. Actually, I don't know what I'm thinking. Never mind. Forget I said that. Just hit Enter. All right, there's our 120. Now, we can take that dividend. And since the next period we're assuming a 15%, we could say times this one plus 15%. Okay, so we have dividend 1, 2. And finally, we need to go out to time 3 with our dividend to get price at time 2. So we take that. And I'm going to go 1 plus the constant assumed dividend increase rate. Now we can calculate our price at time 2, because any particular price time t, as long as we know the next dividend, which we do, we can get that. Next dividend divided by, open parentheses, required return minus our assumed growth rate. Now we have cash flow here, and then we need to add this cash flow and this one. So cash flow at time 1, boop, Enter. Cash flow at time 2, that dividend plus the assumed price at time 2. Now, just a note about this. Remember, our model assumes that all future dividends can be used to get a current price or price at time t. So when we calculate this price at time 2, right here, it really does incorporate all of the future dividends, which are assumed to go out indefinitely, right? So even though we have a price here, it's time 2 number that assumes that it has information, or the price, about all future dividends. So really, even though we're using a price, dividend 2, dividend 1. It's still all dividends that we're using to value this. So now we can take two present values. And we could do this a few different ways. I'm going to do it this way. I'm going to say the present value, the rate, NPER. I don't have a 1 here anywhere. I'm actually going to cheat. Watch this. I'm going to put, no, I'm not. I'll put a 1 and a 2 because we're going to need those numbers. Equals present value, the rate, our 20% discount rate, our NPER. Wow, for this one it's going to be 1, comma, no payment, but there is a future value, and that's the dividend. So then I close, and it's a closed parentheses, and then plus. And we have to do PV again. We're taking the present value of two separate things. So I'm going to say rate, comma, time, NPER, comma, comma, future value. That's it. This one. You know, I'm going to change this one right here. I want to keep this consistent. I have the cash flows here, so I'm instead of that one right there, I'm going to click right here. And then we have our visiting future cash flow expert. What do you think about using future dividends to value stocks?
Can I tell you something?
Yeah, you have the secret stock pick you want to tell everyone about?
Yeah.
What is it? What's the secret stock?
I made a word called stick pin.
Stick pin. Wow. So you guys hear that? That's straight from my 4-year-old son. He says, go out and buy stick pin. I don't believe any analyst when they try to sell me something. All right, I'm going to hit enter, and that's a minus. And it should be because this is a cash flow going out for us buying a stock. So $8.67. All right, let's do another example. I'm going to go over to sheet 8. Here's our situation. We have rad company here. Shares outstanding are 500,000. We are going to assume that for the next 3 years it's going to be high growth. And that high growth rate for dividends will be 20%. After that, it'll tail off, and we are going to assume a constant 5% growth rate. Dividends just paid were $1 million. Our required return is 15%. Can we calculate the price per share? All right, let's go ahead, and we got dividend 1, 2, 3, 4, 3. That's at this assumed 20. And then we'll go out one period. Dividend at time 4 using our 5%. We'll discount that back using our model to get price 3. Price 3 will, in essence, hold all future price information about dividends. So we'll have all of our dividends, and we'll do a present value calculation. All right, so dividend 1, we're going to say $1 million times. I'm actually going to lock this F4. And then in parentheses, I'm going to say 1 plus, oh, that one. And I'm going to lock that one also. Now, what we really need is this. We need caret 1. And then when we copy it down, it needs to go to exponent, 1. And then here it needs to be 2. And here it needs to be 3, right? So we could actually do that, right? Copy this down and then edit it. But I want to try and figure out something a little bit sneakier than that. There's something called, and you can do it that way for the test or whatever if you want. But here, we're going to look at the rows function. I'm going to exponent to the rows. Well, rows tells you how many rows there are. Well, look, I'm sitting in B9, so I'm going to type B9. And then I'm going to hit the F4 key. Actually, I shouldn't have hit the F4. But then I'm going to hit a colon. Oh, yes, that does work. Then I'm going to hit a colon and type B9. Now, look at this. This is weird. One of the cell reference, this is like a range in a sum function or average or whatever. One of the cell references is locked. One of them is not. Well, let's go back to the purpose of the rows. It says, how many rows are there from 9 to 9? Well, the answer is 1. But because this is locked and this is not, when we copy this down, this will remain 9. This will move to 10 and 11. So this is a clever way of getting the number 1. And then when we copy it down, it will show 2. When we copy it down again, it will show 3. So let's try it. Control Enter, and I'm going to drag it down. Just out of curiosity, let's see if it does work. Oh, 9. That one's locked. That one's not. So 9 to 11, there are 3 rows. And you can highlight it and hit the F9 key to evaluate it and prove to yourself that it actually did work. Now I'm going to Control Z because I don't want to hard code that in. All right, now that we have that, these will be cash flows that we'll discount back. But now we got to go out one period to dividend 4 to get price at time 3. So we take that next period dividend divided by our 15 minus our assumed constant rate after year 3. Oh, I'm sorry. That's the next formula. Just pretend I didn't say that. Oh, yeah, now we have our dividend. We need to multiply it times 1 plus the 5%. OK, so dividend at time 4. We're just taking this one, adding 5% growth, enter. Now we can take calculate our price at time 3 equals next dividend divided by R minus G. Now we're going to gather together our cash flow. So there's that one, enter. That one, enter. This one plus this one right here. Now notice the stock doesn't cost 18 million. When we do our discounting back, we're going to divide them by the number of shares, and that'll give us our current price. This actually is the price at time 3 for 500,000 shares, right? Right. All right, so there's our cash flows. Now we can simply say 3 present values in a row. And actually, next chapter, we will learn a new technique when we do capital budgeting, and we'll see a new function that will make this whole process of multiple irregular cash flows a little bit easier. But for right now, this is what we have. I'm going to say present value, the rate, that's the discount rate, comma, the NPER. I'm clicking right there. No payment. Future value is this. I'm going to see if I can copy this. Copy, Control C. All right, plus Control V. And then I have to change 2 things. I have to double click that NPER and click there. Double click this and click there. Plus Control V. And then I'm going to double click there. That's the NPER, so it's that. Double click there. That's the future value, and that. All right, so there's our present value of future cash flows. We need to figure out the price per share. So I'm going to say negative this to get a positive divided by 500,000, $30.40. All right, that's the last video for Chapter 7. Next, Chapter 8, we'll get to start some capital budgeting. That's inside the firm, doing discounted cash flow analysis for various projects to see if they're worth taking on. All right, see you next chapter.